joining me now, we've got John Carney, famed financial journalist, and famed Steve Forbes, Forbes Media Chairman and Editor-in-Chief. Okay, gentlemen, have some fun. You know what I mean? Has to have some fun. Steve Forbes, you first. Who's your favorite of those five?
None of the above. It's going to be Scott Bessent.
Oh, ooh. Now that's very interesting. I didn't put that in. He's taken himself out so many times. He thinks he does protest too much. Is he a supply sider?
He certainly leans in that direction.
Yeah.
And certainly, I think, could have the authority at the Fed to get them off their duff if there's Phillips curve, that prosperity causes inflation.
Mm-hmm.
So he's strong enough of personality and background to do the job and learn. And also, I think he could learn stable dollar, good, weak dollar, bad.
Mm-hmm. Well, I think that's his basic view. So, John Carney, you're next.
I mean, this is going to be super boring, but I think Steve is right. Look, you have the five guys are all good choices. Yes. I have to say, look, I think they could all do a good job. But the guy we need right now has to be a super dynamic leader who is confident enough to buck the Fed. Mm-hmm. And we don't have to worry about him getting pulled in. The Fed is like a black hole for free thought. You put somebody in there and suddenly they just disappear. They get elongated, stretched out. You never hear from the free person you thought you put in there again. I think that Bessent is not, he can withstand that force and actually remain.
Who's going to run the Treasury? Don't answer that. Never mind. I've seen your article on that. I don't want, not today. I don't want to go there today. All right. So 2 for Scott Bessent. You know what? I'm just going to leave it there. I want people, we're going to post this in our various social media accounts, and people are going to have a chance to weigh in on those 5. And if you want to write in Scott Bessent, by all means, write in Scott Bessent, but he's denied it so many times I couldn't put it on there. Okay, so, John, maybe no rate cut in December. Does the guy have a point? Powell have a point? I don't really want to defend Powell. I never want to defend Powell. I want to just say this, one little thing, okay? I know the latest CPI numbers sparked a market rally, which is great, because it came in less than people expected or worried. But I do want to say this, whether you're talking about all items top line or core, ex-food and energy, 3-month change is 3.6% at an annual rate. The target is 2%. And the 12-month change is 3% at an annual rate, okay? Now, I don't think you have to be Jay Powell or a genius. I'm just saying maybe, and given the paucity of economic, maybe these numbers are a little high. How about that?
So I think what Powell is really afraid of is growth. You hit on this in the riff. I think what he is saying is looking at the GDP numbers, and he says, we're growing at 3.8, 3.9%. We can't have that. The Fed thinks you can't grow faster than 1.8% without triggering inflation. Right. And so I think when he's unwilling to say this because, frankly, Congress would impeach him if he said he's going to slow the growth down from 3.8 to 1.8. But that's what's worrying him, that he thinks that's what will cause inflation. His position otherwise doesn't make sense. He said he thinks inflation is going back to 2%. He thinks tariffs are just a one-off if they're anything. And so that's not a reason to worry. There are signs of weakness in the labor market, although we don't know because we don't have the data. So possibly, look, if they don't have data and the December meeting comes around, then sure, maybe.
It wouldn't be the worst thing. I'm not saying they should pause because of 3.9%, right, and which is what the Atlanta Fed GDP tracker is suggesting for the third quarter. I'm saying sometimes you have to look at the numbers. You have CPI. It's well above its own target. Now, this may come down a lot in October, sure. Gasoline prices and energy prices and housing-related stuff, Steve Forbes. It could come down a lot in October. It could come down a lot in November. And by the time we got to all the numbers in December, I might be more enthusiastic. But I'm saying, let's put up on the screen the the Federal Reserve balance sheet, okay? Federal Reserve banks, all assets held by Federal Reserve banks. Let's put this up because the Fed is now saying no more QT, no more quantitative tightening. They're not going to bring that number. That's the basic footings like any bank. It used to be called the monetary base. It's the base for increasing the money supply and so forth. They're stopping now. They're going to leave. I'm worried that a $6.6 trillion balance sheet or monetary base. Now, I know it's down from $9 trillion at the height of COVID, but I'm worried when you go back to 2005, it was around, $1 trillion or less. There's too many dollars circulating. You're a strong dollar guy, okay? So am I. Nobel Prize winner Robert Mundell, who was Art Laffer's sidekick, said tax cuts and tight money. I think there's a lot of dollars circulating, and that undermines the dollar's value. And I'm questioning, I don't think the Fed should stop shrinking its balance sheet.
No, they increased the balance sheet not in response to a crisis. They could have done a one-off and then brought it back fairly quickly. This is about a power play. Even the 6.6 trillion, that's a lot of power. And they want to and the nature of institutions is they always want more. And so they should continue reducing that balance sheet at a good clip.
Yeah.
And if they're worried about inflation, which I am, monetary inflation, looking at the gold price, silver, and copper and the like, what they should do is announce they're no longer going to try to regulate the economy, economic activity, which is what they're doing now. Oh, we must see what the labor market is. No, stable value for the dollar, and then leave it alone. And if they announce that they're going to focus on the dollar, not the economy, I think that alone would get a dollar rally.
By the way, I agree. Kevin Warsh, former governor, who was on that list of 5, has said on this show and in print, he'd like to see that monetary base come down much more, and that would lead to lower interest rates and a stronger dollar. How about that? I think that's very good logic. He's basically saying you're printing too many dollars. As I said before, scarcity creates value. Overabundance, debauches the value. I mean, you do have a $4,000 gold price.
I'm old enough to remember when we thought the $4 trillion balance sheet was really big. I don't understand why we can't get back to the pre-COVID balance sheet, at least, which was very large. They went up a lot. They had come down a little bit. It's still very large. I think the Fed they never told us when they were doing all this QE that it was going to be permanent, that it was going to be this largely permanent, that once they built the balance sheet, they would never be able to bring it down. I think if they had done that, Congress may have made it illegal. That people would have acted against this, but they built it up without telling people that this was what was going to happen. They should be at least explaining, is there ever a plan? Look, I know they've said they want abundant reserves forever. I think that's a mistake. There's no reserve requirement right now for banks. People don't even realize this. We abolished the reserve requirement for banks in 2020, March 2020. It went over everybody's head because we were worried about a lot of other things in March 2020. They abolished the reserve requirement because they had flooded the system with reserves. They don't need it anymore.
By the way, they're still paying interest to banks.
Absolutely.
Almost half of which are foreign banks. I'm just saying.
Foreign banks, the reason why they borrow, why do foreign banks even need reserves? Because they earn a lot of money on it because they don't have an FDIC fee on deposits. So it's an arbitrage play. Foreign banks are the biggest borrowers in the Fed funds market.
4% plus is pretty good money. It's risk-free money. Steve Forbes, what about, I don't know whether this came out. We'll have to look into the notes in Jay Powell's press conference. You're seeing a lot of layoffs now. All right. Now, one can exaggerate this, but 48,000 UPS workers, 14,000 management, 34,000 operations, 14,000 Amazon, perhaps on the way to 30,000. These are layoffs, private sector layoffs. Microsoft, 9,000, Salesforce, 4,000, Paramount, 2,000, Target, almost 2,000. GM made some announcements today. Maybe as much as 3,000. Now, we have 160 million people in the civilian labor force. So these are still relatively small numbers as a percentage of the whole. But it does seem to be, whether it's AI or just downsizing to be profitable, should the Fed be responding to this? I don't know what Jay Powell said today.
Well, what the Fed should do, you talked about paying bank reserves, interest on bank reserves, which is now 4.15. Why not reduce that to 3.15 and announce that eventually it's going to be eliminated? So that way, and make it clear, banks can lend again soundly, especially to small businesses. What has happened since 2008, 2009, going on even before, is the banking system is much less receptive to making small business loans. It's not just the interest rate, it's the collateral around trying to get a loan these days, the paperwork. So let's get the small business sector going. And if you have a job layoff somewhere, you got new businesses coming in, creating new jobs.
Well, just one quickie, John Carney, on this layoff business. What does it mean?
I don't think the Fed should respond to these companies that really upsize their workforces, trying to right-size their workforces. They should be responding to a secular decline in employment, a cyclical decline in employment, meaning if we're heading into a downturn, sure, the Fed can respond to that. But that's not what's happening. This is a technological advance on the AI side. It is companies that really overhired during the great hiring rush post-pandemic, letting some people go. That's not something that I don't think the Fed can do very much about, and I don't think they should try.
By the way, more money doesn't create more jobs.
That's true.
More lower taxes creates more jobs. Deregulation creates more. That's the whole point of supply-side economics. Laffer and Mundell, money causes inflation. Taxes causes recession or growth. Anyway, I got to stop. There's enough. John Carney and Steve Forbes, they both picked Scott Besson, who wasn't even on my list. There's nothing I can do about that.